Warren Buffett's #1 rule to investing is to never lose money. And we all want to make the highest rate of return possible with the lowest amount of risk. But how do you do that when you have a crazy market, a pandemic, and everything that's going on in the world? And chances are you've been presented with those once in a lifetime opportunities.
Once in a lifetime.
And if you spent any time watching YouTube videos, you've probably seen the ads. Yeah, you know the ones I'm talking about.
I came up with a strategy that I've used to take a $2,000 account and turn it into a $2 million fortune. And today I'm going to show you how ridiculously easy that can be to make an extra $1,000 or more every
Let me tell you, I have been presented with plenty of these once in a lifetime opportunities, and I even took a bite on a few of them. I got excited and I just thought, you know what, I'm gonna make a ton of money. Well, that didn't happen. But after 16 plus years of being a financial planner, being the CEO of my own wealth management firm, and then starting an online business that does over 7 figures of revenue,
that's great.
Well, I finally figured it out. And what I realized was the investment strategy that I was implementing was unique. It wasn't original, meaning that there was other people that were already doing it. In fact, it actually had a name that I wasn't even aware of. Because most people assume, since I'm a certified financial planner and had a financial planning practice, they just assume that I would subscribe to what you hear every other single financial advisor talking about. Typically, what you'll hear is asset allocation, having a diversified portfolio. And one of the most common strategies that you'll hear is having a 60-40 stock to bond portfolio. And what this is following is a typical bell curve where you'll have your lower risk investments on one side, the higher risk investments on the other side, and in the middle is where you'll have your stocks and commodities. And this was the strategy that I subscribed to when I first started investing. I started off with mutual funds, graduated to individual stocks, but then after starting my own business, start educating myself on what other investment options out there, turns out the investment strategy that I was slowly starting to adopt was called the barbell investing strategy. All right, so we all want to be financially fit, but the barbell strategy is not about how much you can bench or how much that you can squat. So basically what the barbell strategy is all about is we are eliminating the middle. So we do not have the bonds, we do not have the stocks, we don't have the types of investments that would represent the middle of that investment risk reward bell curve. In the barbell strategy, we cut out the middle. On one side of the barbell, we have our high risk investments. And on the other side of the barbell, we have cash, our super safe, super risk averse type investments. So basically they're gonna be cash, CDs, anything that you can attach the word guaranteed next to it. But why the barbell strategy? Why are we avoiding the middle?
Why don't you just meet me in the middle?
All right, so a thought leader that supports this barbell investment strategy, his name is Nassim Taleb. He's an author, a mathematician, and just a really smart dude. So some of his books are Fooled by Randomness, The Black Swan, and also Anti-Fragile. So what gave him his claim to fame? Back in the 2008 financial crisis, he pretty much predicted it.
Hold my hand, hold my hand, hold my hand. I see something now, yes I do. Yes I do! Yes I do!
He is one of the strongest advocates of the barbell investing strategy, and the prime reason is he just sees how banks are so interconnected nowadays. And because of that, a lot of financial markets, a lot of financial instruments, investments have been over-engineered. And because of this, smaller shocks to the system will have tremendous and exponential more impacts, and that's why you see the market swing in such huge droves than it used to back 10, 15, 20 years ago. Now, he may sound like some sort of conspiracy theorist, but hold up, hold your horses.
Hold your horses, hold your horses.
Because let me give you 2 real life examples that shows what he's talking about. So the first example are mortgage-backed securities. Now, we can go back to the 2008 financial crisis, the Great Recession, to see why these are a perfect example. So the way that mortgage-backed securities were packaged and the way that they were priced using these models, they never accounted that home prices could go negative. And when they did, that's why we saw so many people first getting approved for loans that shouldn't have. And when the market started to drop and we started to see housing prices fall, that's when it all went to you know what. All right, so another example are stock buyback programs. You have seen this in the news, or maybe you have missed it, but there have been tons of companies that are buying back their stock in order to increase the price of the share. And the way that they're able to do this because interest rates are so low that they can take on more debt at extremely low rates to then go back and buy more stock. But the problem that we have here is that when they do this, they are taking cash from the company. They're dipping into their savings account to buy back this stock. So what happens if this pandemic continues much longer than anyone has expected, or we have another pandemic or some sort of other crisis or recession? These companies aren't going to make it. So now that you know why to avoid the middle, let's talk about the barbell investing strategy. And let me show you exactly how I use it. Okay, principle number one with the barbell investment strategy you need to know is that cash is always king. Cash isn't trash. And where did the cash is trash come from? So billionaire hedge fund manager Ray Dalio, he had this to say on CNBC.
Cash is trash.
Now, obviously, Ray knows a thing or two about investing since he is a billionaire hedge fund manager. But what he has to say about cash is trash is more applicable to the average investor. And it makes sense. Like, interest rates haven't got better ever since he said this. In fact, interest rates have gone down. One of the most popular savings account online, Markets by Goldman Sachs, continues to see their interest rates drop. So why am I here still arguing that cash is not trash and it is still king? Well, here's why. The sole reason why cash is king, especially with the barbell investment strategy. Now remember, we've got two sides of the barbell. On one side, we have the high risk investments, and on the other side, we want to protect the high risk investments and we want security, we want safety. But most importantly, we want liquidity. We want access to this money because having cash on hand gives you options. Having this overabundance in cash tucked away in a savings account that I know is making next to nothing. But even still, it's given me the ability to pursue these different high-risk investment opportunities and business opportunities without fear, without anxiety, so that I can pursue it full on, full send, all in, because I know I've got cash to protect me just in case. And the second reason is options. I can't tell you how many times that an investment opportunity or a business opportunity came along that because I had cash on hand that I could go to the bank, or even with my self-directed 401k, I could write a check and place money in this investment. Now, some could argue like, oh, that's not good because you're going to invest into high-risk investment opportunities that you aren't thinking it through, you're not doing it out of good conscience, you got YOLO syndrome. And yes, I've got burned on this a few times, as I mentioned in the beginning, but that was then, this is now. I have a certain filter that I run through before I make any investment so that I'm not jumping into anything that I may regret. And the best part is that once it clears my filter, I have the cash on hand to make it happen. All right, the second principle that is key with the barbell investment strategy, and many people dismiss this because they think it's a waste of money. But the key principle number two is having the right and proper amount of insurance. Now I get it, insurance is boring. You can waste thousands and thousands of dollars on insurance, and the hope is that you never have to use it. But having this barbell investment strategy, when you are making high risk investments into whatever that is, whether it be Bitcoin or a small business or some sort of startup, you want to have some sort of protection. Now, straight from the gate, I didn't have every single type of insurance. One of the key parts of insurance I had, or one of the key types of insurance I had, was life insurance. That's after I got married. And as I had more and more kids, I just kept increasing my life insurance coverage. Right now, I think just on me alone, I have $2.5 million of just term life insurance. In addition to life insurance, we've got our health insurance, we've got our home insurance, our auto insurance, we've got an umbrella policy. With my business, I used to have what was called E&O insurance. There's also Keyman life insurance. So there are different types of insurance that are crucial if you are going to adopt this barbell investment strategy. You don't have to get it all at once. You start off what you need and then you just build from there. Principle number 3, now this is a surprise to many, but having a low exposure to stocks and bonds. And that may seem kind of weird because you've seen my Grow Your Dough Throwdown. You've seen my recent Fiverr video where I was day trading. And I do have some stocks. I do have some ETFs. And that is mostly done on this channel because I want to show people that have never invested before how to start. And that's what I started with. I started with mutual funds, ended up graduating and buying some individual stocks. So there are still some positions that I hold, but a majority of my portfolio is not tied up in stocks. It's not tied up into ETFs. It's not tied up into mutual funds. I don't think I own any bonds whatsoever. So I have some exposure, but a majority of it is tied up into my high risk investments. And I guess technically you could consider the day trading account a high risk investment, but even the size of that account is a fraction of my total portfolio, and that is really more just for fun. And that's what you do with the barbell investment strategy. You are going to set aside 5 to 10% of investing where it is just for fun, or you're investing into things more traditional like individual stocks. Maybe you want to trade commodities, maybe you want to trade options. And that's what I've been playing around with, trying to day trade even though I'm not logging into my account every single day, but just testing out new things. And I just do that because I want to stay relevant. I want to stay current. I like to try new things. So it satisfies that creative itch, that creative urge that I have to try out new things. But the remaining percentages, this is what the barbell investment strategy is all about. So this is where you want to place anywhere from 10, 15, maybe even 20% exposure into high risk, high return investments. Since this concept might be new for many of you, when we're talking high risk investments, oftentimes if you're a newer investor, you may be thinking about the S&P 500. That's average 8 to 9% return over its historical average. Now, that is decent return, but we're not talking about making 8% on our money or 6% on our money. What we're talking about is we're placing our money into some high risk investments. That could be some sort of tech startup. That could be some sort of real estate investment trust. Maybe you're buying into some company that's just getting off the ground. I mean, either way, we're not talking about making 6%, 8%. We're talking about making anywhere from 4 to 100 times your investment. So if you have $10,000 to invest, by the time that you get out, your $10,000 has grown to 40,000, or it's grown to 100,000, maybe even $1 million if you pick the right thing. Now, one could argue that investing into an IPO, say like if you would have bought Tesla, Facebook, Google, or any of these tech giants back in the day, you would have made a lot more than your 6 to 8% per year. So that is an example. Now, for me personally, where I've seen the greatest rate of return on any of my investments is reinvesting back into my business. That was my financial planning firm until I sold it. That's also been my online business. And the way that I've been invested or reinvested back into the business is through hiring key employees, or even most recently, I just did a redesign of my main blog, goodfinancialsense.com. And that redesign, I think the final price tag on that was anywhere between $25,000 to $30,000 for a website redesign. That is a lot of money. That was a lot of money to reinvest back into the business. But anytime that we've done any major updates like that, we have seen tremendous exponential results that are comparable to the 4 to 100 times like I mentioned earlier. And I'm sure there are options traders that would say the same thing, or real estate investors that have experienced the same type of return. I'm sure many of them subscribe to a barbell investment strategy or some sort of mixture of the sorts. But the reality is that when you have cash on hand, when you have that extra surplus, it allows you to invest into things that most people, they don't have the cash, they can't get the cash, they don't have the creative financing to get it done. But most importantly, they don't have the ability to make it happen. Well, I'm sure that options traders would argue that they make a similar type of return. And I'm sure there are real estate investors that also have made anywhere from 4 to 100 times on their money. And I'm sure if you actually peel back the layers and look behind the curtain, if you looked at their entire portfolio, it would look something comparable to the barbell investing strategy, or some sort of variation that's very, very similar. But the key is, with a lot of these real estate investors, options traders, even day traders, you gotta have cash, you gotta have the money on hand. And that's where the barbell investment strategy just works. So what do you think? Do you think that this is a strategy that you could rally behind? Do you agree with the idea of avoiding the middle and having cash on one side and high risk on the other? Let me know in the comments below. Really appreciate you checking out this video. If you got any value, be sure to like, subscribe, all that fun stuff. This is Jeff Rose reminding you that it's your money, it's your life, know you can make it awesome. Until next time, peace.